Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Capital Group's Julie Dickson. Hello, Julie.
Hello, thank you for having us.
Thank you very much for being here. The rhetoric surrounding US equities is that they are very expensive. However, when you drill down to look at what has been driving the stock market returns in S&P 500, for example, over recent years, it looks very sector specific, doesn't it?
Well, indeed, the large technology companies have really become a very significant part of the U.S. equity market, over 25%. They've shown some spectacular growth, both in profit, but also the sheer price movement in the markets for the last few years. So it's indeed, if you look at the U.S. equity market just on its top level, it will look expensive. But interestingly, once you take those companies out of context and you look at the rest of the market, there's some really interesting opportunities out there.
And are there any particular sectors that have lagged that average, the very opposite to those tech stocks?
Well, there have some been sectors. Now, the way we invest at Capital Group is we're very fundamental, very bottom-up. So the way we look at sectors is really just a result of the individual opportunities that we find. And there have been opportunities in healthcare, opportunities that have been basically in areas that have just been overlooked because the market's been so focused on the growth of the tech engines and the disruptors that are out there in the market. That being said, those are still companies that are still growing, so they still have a place, somewhere in the portfolio.
So another driver recently of U.S. equity returns, as well as the tech stock growth, has been Trump's tax reforms. However, some people say this is already priced into the market and so won't be a driver in the future. I know you say that you're stock selectors and fundamentals, but people or companies suddenly having more cash to play with must be a benefit, right?
Well, again, we don't really speculate on the outcomes of these political agendas. In the market, we look at how companies individually will be able to take advantage of these different policies as they come through. And we try not to predict too much what these policies are going to be. But what is true that in terms of corporate profits in the U.S., the tax reform has been a tailwind this year. In terms of next year, in general, we do expect earnings to still grow, but probably at a slower pace than we've seen this year because those tax effects won't be there.
Now, I wanted to pick up on something you said about tech stocks, which is that you said, but they are still growing.
Yes.
Does that mean, yes, they look expensive on some multiples, yes, they have done incredibly well, but we should continue to expect them to?
Well, so some of these companies are they're innovators, they're market leaders. If you look at how the leadership of the U.S. equity market has changed over the last 20 years, it's gone from very industrial, very commodity-driven, consumer-driven companies to the big tech giants, whether it's Alphabet, whether it's Facebook, whether it's Amazon, which is still classified as a consumer company, not a technology company. They are all companies that are disruptors, that are leaders in their field, that continue to grow. So some might think, that the valuations might look expensive today. But again, in our view, we really look at the long term, and we look at the sustainability and the quality of that earnings growth going forward. And in some cases, we think the valuations are justified.
Julie, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.